Interest rates for students taking out new federal Stafford college loans doubled July 1st, up to 6.8%. That's because Congress failed to take action before its July 4th break to keep rates at 3.4% or tie rates to other economic indicators. A study by the Urban Institute estimates that 1 in 5 Americans over the age of 20 owes money on a student loan, and 57% worry about their ability to repay them.
This right here is the what?
More than 150,000 Oklahoma students borrow money to pay for school. Eileen Thomas is one of them. After being recently widowed, she signed up for classes at Connors State College in Muskogee and Tulsa Community College. Thomas wants to become a sign language interpreter. The loan, she says, will help her make that dream come true.
My classes, I've had to borrow the money. You know, I didn't want to have to do that, but I need to get finished with my degree. I want to do that.
Oklahoma's total student loan debt is approximately $1.5 billion.
I think I only owe about $18,000 right now, which is not bad.
This spring, national student loan debt surpassed what Americans owe on cars and credit cards for the first time in history. A study by the Federal Reserve Bank also found the number of 25-year-olds with student debt climbed from 25% in 2003 to 43% by 2012. More significantly, the average amount of student debt nearly doubled in that time, from about $10,000 to $20,000, and it's still going up. Nationally, the average student now racks up almost $27,000 in Stafford student loan debt while in college.
You will see a unit, a room.
In Oklahoma, that amount is lower, about $21,000. Stafford student loans are normally repaid in installments over a 10-year period, beginning within 6 months of graduation or the student dropping out of college. The monthly payment on $21,000 in student debt is $206 when the interest rate is 3.4%. Total interest paid on the loan, $3,800. When the interest rate jumps to 6.8%, the monthly payment shoots up to $242 a month, with $8,000 in interest paid on the loan. To help students understand the financial obligation they're taking on with student loans, websites like finaid.org have repayment calculators. They show how much students are required to pay back each month based on loan amounts and interest rates. Thomas says many of her classmates, especially the younger ones just out of high school, don't seem to understand student loans have to be paid back.
It's amazing. I think they think of it as free money.
OCAP, Oklahoma's College Assistance Program, just launched an expanded student loan management website called Ready, Set, Repay. It takes students through every stage of the loan process: borrowing, repayment schedules, and what to do if they get behind on payments or default on a loan. 2 of its calculators are especially helpful. For instance, those anticipating a starting salary of $25,000 a year should take out no more than $14,000 in student loans. That's considerably less than most students actually do. The second calculator can be a real eye-opener as well. Those with $21,000 in loans at an interest rate of 3.4% need an annual salary of $31,000. At 6.8%, they'll need to earn at least $36,250 a year to pay back the loan.
I think if students are aware of what they're getting into, I think they'll be more likely not to take out so much student loan debt.
Jennifer Watkins is the financial aid director at Connors State College. Her institution just received a $50,000 grant to provide financial literacy training for next fall's students. It's to help them understand that just because they're eligible to borrow a certain amount of money, it's not always in their best interest to do so.
I think a lot of students do take the max more than anything because they don't have that education up front telling them not to, or what the consequences could be in the end if they can't pay that loan, or when they get out, how much are they going to be making. So in a realistic way, they need to be thinking about those things before they borrow and not after.
Increased interest rates and borrowing too much could result in more students defaulting on their debt. 13% of Oklahoma's students already default on their student loans. That's the 5th highest default rate in the nation, according to the most recent figures from the U.S. Department of Education. Student loan default rates have consequences for both students and colleges. Students who default on loans can't just walk away or get them discharged through bankruptcy.
Only students who are 100% disabled could possibly get their loans discharged.
When a student goes into default, his wages, tax returns, and other sources of income are subject to garnishment until the loans are repaid. And as of 2014, colleges risk losing the ability to offer federal student loans and Pell Grants if their students' default rate is above 25% during the previous 3 years.